Okay, this is the financial plan for Jake and Amy Edwards. Hey guys, thanks for meeting with me over Zoom today. Obviously, would like to meet with you guys in person, but with everything that's going on right now, this is how we kind of have to deal with things. So, what I've done for you today is I've sent you over your financial plan, and as we're kind of going through things here, I'd like you guys to kind of go through it with me. Um, I'll be referencing different pages so you guys can kind of follow along with what I'm talking about. So, first of all, page 2, there's a disclaimer. Um, that's basically saying that you guys need to stay up to date on your financial plan with changing laws and stuff like that. Page 3 is the engagement letter that you need to sign stating that you're aware of the services and stuff that we're providing. So, digging right into it here with your guys' personal information. Jake, you're 60 years old, Vice President of Deluxe Corporation. Amy, 58 years old, Senior Vice President of Hormel. You guys have 3 children, April, Chelsea, and Ryan, and also 3 grandchildren, Ashley, Megan, and Steven. Currently live in Bloomington, Minnesota. Based on your risk tolerance quiz that we did for you and conversations that I've had with you guys, we've determined that you're a moderate risk. And then the main concern for the visit today is to get a second opinion on the financials that you have with the potential large estate and estate tax liability. So we'll start with going over your current financials on page 6. This is a statement of your net worth, kind of going through your assets and liabilities. Looks like roughly you have about $8.5 million worth of assets, $280,000 in liquid cash, and then $5.7 million in investment accounts, and then also $2.5 million in personal use assets. Only one liability, which is an auto loan for $18,000 at 4.5%. For the statement of cash flows, looks like Jake, you're bringing in about $160,000 in salary per year plus a $30,000 bonus, and then Amy, $360,000 a year with a $130,000 bonus, and then also $160,000 of deferred compensation. On top of that, you guys have some investment income from your brokerage account in ordinary and qualified dividends. The only difference between these two is a little bit different taxation. Expenses, personal expenses, about $280,000. Taxes, you guys are in the highest income tax brackets, both for state and federal, paying about $255,000 a year in taxes. Both maximizing your contribution to your 401k, putting about $83,000 into the brokerage account, and then you got the deferred compensation as well as capital gains and dividend reinvestments. So on the next page, page 8, this is kind of a little pie chart of your expenses for your guys' benefit to see kind of where you're spending the majority of your money. It's just a tool to help, I guess, give some insight in where your money is going. Page 9, we'll kind of come back to that later when we're talking about some stuff that we're going to do with the brokerage account, if you want to set that aside for now. We don't need to go through page 10. So page 11, this starts with your guys' goals. I'm just going to run through them quick here. You want to figure out how much that will be needed for retirement and long-term care. Verify that your funds are being properly invested for the best taxation. And then you'd both like to retire in 7 years when Amy reaches age 65. Minimize your estate tax liability upon death. Leave some funds to United Way upon death, which you're already donating to each year. You want to make sure that your money and assets are being efficiently distributed to your children and grandchildren, and you'd like to fund your grandchildren's education. And the last one here is you'd like to ensure that in case of a prolonged illness, nursing home, that you'd like to still leave something to your children. So I'm going to run through some other financial information that you guys have here. Both have universal life insurance policies, $1 million each that you purchased 10 years ago. Jake, you're paying about $5,400 a year for that, and Amy about $3,400. And you're planning on stopping the payments at age 65. No long-term care insurance, currently in the highest tax bracket, like we said before, at both the state and federal brackets. You have simple will that was created for the distribution of your assets, and then a healthcare representative or healthcare directive with each of you as the representative, and then April, your oldest child, as an alternate. So you have all of your accounts under your own names, but both of your names are under the Edwards accounts. So moving on to page 12, these are going to be some of the assumptions and estimations that I'm using throughout talking about the investments and stuff like that. The inflation rate that I'm going to use is about 2.5%, which is pretty conservative based on the last 10 years being at an average of about 1.9%. The investment interest rate, I'm going to use 5.5%, and I got this from an online calculation based on your moderate risk tolerance as well as historic averages in the market. And then for your retirement year, I'm going to use what you guys had for your goal of year 2023, which is 7 years away. For the full retirement age, I use 67 years of age, which is just a couple months more than each of your actual calculated retirement age. I think one was 66 and 2 months, and the other one was 66 and 8 months, so we're just going to round up to 67. For tuition, I use $23,000 a year in today's dollars on average, and I'm inflating that at 8% each year, which is kind of the average over the last 10 years. So that $23,000 is between about $17,000 for public college and $26,000 for private for-profit college. For expenses in retirement, I used $280,000. So this is similar to what you guys are spending now and will keep you living the lifestyle that you are right now. If you'd like to increase your life expectancy, we'll have to adjust the expenses accordingly, but we'll talk about that a little bit later when we get into the retirement stuff. For the estate tax exemptions, I use about $5.5 million per person for federal and $3 million per person for the state of Minnesota. So, moving on kind of into page 13, we're going to kind of start getting into the plan here and how I addressed some of the goals that you guys had. So the first goal you have that I have listed on there for you is leaving some funds to United Way. So if you pick up page 14, this page talks about a charitable remainder trust. So what we're going to do with that, I'm going to have you pick up page 9 as well. We're going back to your brokerage account. And I want you guys to kind of look at the cost basis compared to the current market value of this brokerage account. Right now, you have about $450,000 in capital gains between the cost basis and market value. If you look up in stocks at your Google stock, the capital gain in that stock alone is $450,000. So what I'd like to do is over the next few years, I want to start putting some of that Google stock into a charitable remainder trust. So there's going to be multiple benefits from this. The first one is each amount that you contribute to that is going to be an itemized deduction on your tax return. And this could potentially lower your income tax bracket over the next few years, which would be huge, being that you're in such a high tax bracket. Another thing is, once you start putting those assets in, you will get income from this account throughout the remainder of your life. And then when you guys pass away, the remainder of the assets in the trust go to United Way. The last thing that it does is it gets that money out of your taxable estate, which we'll talk about a little bit later. But a bunch of different benefits from this account that will benefit both you and your goal of donating to United Way upon your death. The other option would be just to contribute the stock outright to United Way, but that's not going to receive the benefits that this charitable remainder trust is going to provide for you. So, moving on to the second goal there, and we're going to put the third goal into this as well, is making sure your money and assets are efficiently distributed to your children, as well as minimizing your estate tax liability. So if you pick up page 15 here, as I'm sure you guys are already aware or have been told, Minnesota is one of the worst states to live in for estate tax. So their rates are high and their exemption amounts are pretty low compared to other states. So today you have a total of about $8.4 million in taxable assets to your estate. And the goal is to get this below $6 million, which, if you recall earlier, the exemption amount per person is $3 million, so you each get $3 million for a total of $6 million. So you're already below the federal tax exemption rate, so we're good there, but we're going to try to get you below the $6 million. So the first thing we're going to do is we're going to put, assuming that the cost basis in your house is pretty high, we're going to put that house, your lake house, and then your furniture in an irrevocable trust. And so what this is going to do is that's going to take about $2.3 million out of your estate. And then also by doing this, we're going to name each of you as the beneficiary, and then upon death, the beneficiary becomes your children in equal capacity to each one of them. So a couple different things this is going to do. This is going to make sure that you're giving, some of these assets to your kids upon death. The nursing home or whoever will not be able to get at these assets once you put them in the irrevocable trust. The downside is there's not much flexibility once you put assets into an irrevocable trust. There's no changing the wording of the trust and how it's set up. So, that's kind of where I think we should go with that. Your estate is going to be further reduced by the funds that you donated to United Way in the charitable remainder trust, and that's going to get you under $6 million. And so after you do these few things, I'd like to split the assets that remain evenly between the two of you so we can maximize each of your exemption amount. And so in summary, at the bottom here, the exclusions from your taxable estate are going to be the stock funds that you put in to your charitable remainder trust. The 529 plan that you already have isn't in your estate right now. And then the assets that are put into the irrevocable trust are taken out of your estate. And that lowers the liability to under that $6 million threshold. So, moving on to the next goal of retiring in 7 years. If you guys want to grab page 16 and 17, I've got a spreadsheet set up here for you guys. So, what this is doing is it's taking your investment accounts and it's growing them out for the next 35 years. And it's showing how much money you guys are going to have to spend in retirement, kind of a little bit about what the taxation is going to be on those accounts. So looking at it, I'm going to go through a couple of the things at the bottom. The highlighted columns are full retirement age, which for Jake is going to be 2026 and Amy 2028. RMD means required minimum distribution. We'll get to that in a little bit here. Your retirement year is 2023, which is 7 years away. And then 2048 is going to be when your accounts through this setup run out of money. And that's at age 90 for Amy and 92 for Jake. So the investment rate that I use, which we talked about earlier, 5.5% is what these are growing at. Expenses are inflating at 2.5%, and then Social Security is increasing at about 2%. And then again, your retirement age is 67 for each of you. So looking at this here, I grew each account from right now into 2023, your retirement age, and then at year 2023, we're going to start taking distributions to match the expenses on page 17 over here, and those expenses are growing at 2.5% each year. So that's the goal, is to get to those expenses. That's how much we want to take out each year for you guys to live on. And also on the right there is each of your Social Security. Jake will start 2 years earlier because he's 2 years older than Amy. So for the first few years, we're mainly only going to be pulling from the brokerage account. Now, what this is going to do, if you recall, we took some Google stock out of there into the charitable remainder trust. And then what that's going to do is it was pretty much a wash between the capital gains or the cost basis and the market value. And so obviously those assets are probably going to grow in the next 7 years. So you will have a little bit of gains between your cost basis and the fair market value of the account, but it's going to be really low. So the value, if you see in 2023 of your brokerage account, is going to be about $2.18 million. Now, that's about a $700,000 increase from 2016. That means you'll have about $700,000 in that account of capital gains. And that is only about 31% of the account is capital gains. So what that means is 31% of the money that you're going to be pulling out of there, that's all that's taxable. And that's taxed at 15% capital gains rate, which is really low, especially compared to what you guys are paying in taxes now. Then along with that, on the right there is going to be the Social Security, and that's only 85% of your Social Security is taxable, and that's going to be at ordinary rates, which will be low because that's the only taxable income that you're going to have. So for the first few years, we're going to start pulling out of the brokerage account, and then back to the required minimum distribution. In your retirement accounts, once you hit age 70, you have to start taking a minimum distribution out of each of those accounts. So for Jake, that's going to start in 2026 from both his IRA and 401k. So you can see under the RMD in each of these retirement columns that there's a percentage. And so that percentage has to be taken out of the account each year. So what we're going to do is we're going to subtract those minimum distributions off of your expenses, and then what's ever left over that you guys still need, that's going to come from the brokerage account. And then that's going to happen until the brokerage account runs out in 2037. And then we'll start pulling totally from your retirement accounts. And I did that at about 20% from each of your IRAs and then 30% from each of your 401ks. So if you continue that on with each account growing at 5.5% per year, as well as taking out the expenses each year, which are inflating, you'll run out of money at about 2048, which is at age 90 and 92. And that's pretty good. That's well above the life expectancy. If you guys wanted to have a higher age when you run out, we could adjust the expenses a little bit. There's some different incomes that you guys have that we'll talk about a little bit later that we could be flexible with and fund some of these accounts a little bit more. But this is where I have it right now, and it's kind of whatever you guys are comfortable with doing. So that addresses your retiring in 7 years. The last goal that I have on there is funding your grandchildren's education. So if you pick up, it's page 18, this talks about the 529 plan. So Jake, right now you have a 529 plan with about a value of $112,000. What we're going to do, or what I think we should do, is start taking the dividends that you guys are getting from your investment brokerage account and putting those into the 529 plan. So a couple things that's going to do, it's going to get that money out of your estate, which again lowers the possibility of an estate tax liability. And then also, if you see here, the 529 plan growing at about 5.5%, same with the dividends up until your retirement age. And then you'll need to make 4 equal distributions or 4 contributions to the account after you retire of $50,000 each, which should easily be attainable from the dividends that you'll still be getting from the brokerage account. So on the very right, there's the tuition that's growing at 8% per year. And so that's going to show you what you need each year for each grandchild's college tuition. So if you end up having, which you might, more grandchildren, then we're going to have to kind of tweak this a little bit and figure out where we can get some more funds coming into this account over the next few years to fund some additional college tuitions as well. But right now this plan looks like it should work and won't run out of money before the last kid gets done with college. So moving on, if you guys want to look at page 19, this is kind of going to talk about how I think we should diversify your portfolios in your investment accounts. So this pie chart was based on a smart asset allocation for your risk tolerance, which was moderate, saying that about 65% should be in stocks, 30% in bonds, and then 5% in cash. So your current allocation of your brokerage account after Google is taken out is about right on to what this asset allocation says. And then on top of that, I'd like to get your other retirement accounts kind of in the same boat, on the same level as this. Well, I'm thinking about bonds. One other thing that I wanted to mention, if you go back to your brokerage account statement and you go down to the fixed income section, you've got some bonds there, some taxable bonds. I think we should change a couple of those to tax exempt bonds. And the reason that I say this is if you look at like Colgate Palmolive at a 1.95%, that's getting taxed at about 40-50% where your income tax is. So you're losing about 50% of your percentage there to get down to about 1%. And there is some tax exempt bonds that are going to be quite a bit higher than that. So I think that would be beneficial in that aspect, being you're in such a high tax bracket right now. So yeah, if we go to the last page, page 20, I just have a couple other recommendations that I'd like to make. I would pay off the auto loan with the money from Jake's checking account. And the reason for this is that auto loan is costing you 4.5% interest, while your cash that's sitting in your checking and savings isn't making you barely any. So you've got the money to pay it. I would just pay that off right away. I think the money in your savings account is adequate. It's about 4 to 5 months of salary, so that looks good. I think you should purchase a long-term care insurance policy. Now, this is not saying that if somebody would go into a nursing home that with your guys' assets you couldn't fund it, but being the age you're at right now, if you would start purchasing a policy now, the average premium would be about $2,700, which provides about $161 a day in nursing home care. And in your situation, I think that's a pretty affordable expense for potential savings of $60,000 a year in nursing home costs. For the deferred compensation, I haven't gotten into this yet. I'm assuming that it's going to start being paid out upon retirement. This will be beneficial to you guys because you'll be like I mentioned earlier, you're going to be at a way lower tax bracket. And then you've got some flexibility on what you can do with that. You could start putting that money into the irrevocable trust to your kids and start building the funds into that account. So you make sure that they have, I guess, more money and more assets upon your death. Or you could, in the case that we talked about of having more grandchildren, you could start funding the 529 plans more. Or you could start funding your retirement accounts, your brokerage accounts more, so you don't run out of assets until a later year. But that's kind of up to you guys on how you want to do that, but there's some flexibility there. For your life insurance, I would think that's more than adequate. You have enough assets to take care of each other if one passes away. And then, if you guys are planning on stopping your premiums at age 65, I think that should be sufficient. So, I guess now I'm open to any questions you guys have. Like I said, I appreciate you guys doing this online with me. Obviously not an ideal way to do it, but yeah, thank you guys for for letting me work with you, and thanks.